All right, so we want to be respectful of everybody's time who has joined us. I have 11 o'clock on my watch. So, Alp, if you're ready, shall we get started?
Sure, I will start it. Good morning, and thank you for joining us today. This is Alp Adeback, and I'm here in our offices in Bethesda, Maryland, joined remotely with Jason Dahl, I guess in Capitol Hill down in DC. And he's broadcasting live from his basement.
Live from my basement. I wish my basement looked as fancy as this fake background, but maybe somebody can dream. So thank you, Alp, and thank you everybody for joining us. But before we get started, I just want to quickly let everybody know that we are recording this, and we will share the recording and the slides with everybody who has attended. Natalie will send those out to folks as a follow-up. Usually takes 2 or 3 days to get all of that kind of put together in that package ready to send out. So we will share that. The recording will also be posted on our website and on our YouTube page. So feel free to check that out or share it with anybody who you think may be interested. Of course, please don't hesitate to follow up with us after the presentation if you want to schedule a time to chat. We've been doing lots of Zoom calls, and so happy to do that. And I also want to mention that while we did get some questions in advance of today's presentation, and we will address those as we go through today's presentation, during the presentation, please feel free to also submit questions via the Q&A chat box, and we will keep that up and keep an eye out for those. And if there's, like I said, if there's anything that maybe you think of after the fact, please feel free to follow up, and we'll have all our contact info available at the end of the presentation. So without further ado, Alp, I'm going to let you take the lead here.
Excellent, thank you. Let's move ahead a slide. And so we decided to create a timeline of what has happened over the last 13 months. And we know a screen like this, and believe it or not, there's 4 pages of this. We know it violates every rule of don't put too much data on a slide, but we thought it was fascinating. We're not going to go over all of it, but we will go over some of the highlights, but it kind of leads up to where we are, how we got to where we are, and it's really amazing. So, the market started off 2020 fairly strongly. I mean, we were basically pushing the markets up to new highs, and the first crack of 2020 is when OPEC and Russia started having a little breakup, and that sent oil prices plunging. And then on March 11th, the World Health Organization declares the coronavirus outbreak a pandemic. And basically mid-March, the pandemic hit. And Jason, what was the date that we kind of sent our crew home?
Friday the 13th, Friday, March 13th.
And I remember that we basically told everybody that, okay, we'll probably be back in the office in 2 to 3 weeks. So stay tuned. We were actually set up for it perfectly. We had actually rehearsed, not a pandemic, but we just said if we had to work at home, if we lost the internet in the office, whatever it may be, we were set up for this. But basically, the economy shuts down, jobs were shed everywhere. But what's really, really interesting is it was business as usual with a twist for some. And we kind of say that for our office, that things didn't change. Essentially, we just started having Zoom calls, right? And on March 19th, Zoom became the unofficial king of the quarantine economy as the video conferencing company became more valuable than Uber, which was one of the darlings previously. And so again, in March 23rd, we saw the fastest bull market to bear market reversal in history. The markets basically at that point had dropped 20% and went down further than that. April 2nd, 6.6 million Americans filed for unemployment during the last week of March. Next slide, Jason. Worldwide cases surpassed 1 million on April 2nd. April 13th, we started getting the coronavirus stimulus checks. So that really helped us out a lot. So April 14th, we had the fastest bear market to bull market reversal in history, meaning that we were now back up over 20% from the lows. Employment report on May 8th showed that the economy lost an unprecedented 20.5 million jobs in April, and the unemployment rate soared to 14.7%. May 20th, the world passed 5 million COVID cases. So really fascinating. Next page. On June 9th, basically not long after they declared it a pandemic, the NASDAQ hits 10,000 for the first time ever and closed at a record high. August 11th, world crosses the 20 million case mark. October 2nd, if everybody remembers this, President Trump announced that he tested positive for COVID. And November 3rd, probably the story of the year outside of the pandemic was the election, nonstop news. November 16th, this was a big day. Moderna announced its COVID-19 vaccine has an efficacy of nearly 95%, and that was followed up with Pfizer saying the same thing. That news was incredibly well received. And then on November 24th, the Dow Jones hit 30,000 for the first time. Just another sign of just how strong the economy is, in the midst of a pandemic.
I know my son, Leo, that's his birthday. He was really excited about the Dow hitting 30,000 on his 9th birthday.
So moving forward.
Yep.
And so if you take a look at, when we started getting the vaccine, out in the public, December 8th, a UK grandmother became the first person in the world to get the Pfizer vaccine. And then we just started getting positive announcement after positive announcement about the vaccine. So that was something that the markets really just took to very kindly. What we thought was going to be a problem to the market's recovery, January 5th, the Georgia Senate runoff, we actually thought, and we're not trying to make any political statements here, we thought the market would favor all along a Biden presidency, even though we thought that the markets would actually, the US markets would do well with either a Biden or Trump presidency. We thought that the international markets would do better with Biden, but we thought the markets would actually respond positively if the Republicans had retained the Senate. And so at a 50-50 turnout with the Democrats getting both seats surprised us all. So we thought that was going to be a big issue. It really, the markets kind of shrugged it off. The bigger issue was the Capitol riots on January 6th, but even that, the markets shrugged off. And in mid-January, we had record highs in the Dow, S&P 500, and the NASDAQ. And on top of that, I would tell you the international investments and value investments, all of that joined the game. So the rally really started broadening out. And as everybody knows, January 20th, we had the Biden inauguration. So, surprisingly, this market has faced just an unbelievable level of obstacles over the last 12 to 13 months. And for whatever reason, right, it has just continued to move forward. And so the next slide, we'll talk about it a little bit.
Yeah, it is kind of remarkable. I know we've looked at this a lot, but even going through it again, it's like, wow, there was so much in 2020 and into 2021 so far. So before we transition into the next slides where we get into some of the weeds a little bit, if you will, I think we got one of the questions that we received is a great segue here. And the question was, why did the stock market do well in 2020, although not yesterday, as they pointed out, when the economy shrank so much? And Alp and I were talking, we thought that's a great lead in right here to our first slide.
Yeah, and so there's a famous Wall Street line that you don't fight the feds. And if the feds are trying to stimulate the economy, they will eventually get it right. And the way they try to stimulate the economy is lowering interest rates. And so as you can see, we are now back down to a 0% interest rate economy. And there's a phrase that we coined in the office about 5 or 6 years ago, and it was that low mortgage rates are the gift that keeps on giving. And if you think about it, for people that have been refinancing their homes literally for the last 10 to 15 years as interest rates have declined, this final leg down, I won't say hopefully, they could even go lower, but this recent move down in mortgage rates has people refinancing again. And so even if they had a mortgage from a year and a half ago and they were paying 3.5 to 4% on it, people are now refinancing. We're hearing 15-year loans at 2%. We're hearing 30-year purchase loans at 2.5%. But for people that are refinancing, it just adds a lot of extra money to the economy. We hear story after story of people telling us that they're paying less in mortgage payments than their kids are paying for renting a 1 or 2 bedroom apartment somewhere in a city. So really, interest rates are a big driver of the economy, and the feds themselves, they are trying to do whatever they can to stimulate the markets. And that actually holds true on a global basis. Every central bank around the world is trying to stimulate the economies.
Yeah, I think we often talk that if there's one kind of single variable that's probably the most influential in the returns in the market in 2020, it's probably represented right here.
Yeah, and I would say one thing that can't be discounted is the markets have this tendency to always look forward. And people say it's like 6 months to 12 months. So after an initial shock, such as the oil shock and the pandemic shock, the market started saying, you know what, we're going to get through this. And there really will be some winners and losers. And they priced it accordingly. So it was fascinating.
Yeah, yeah.
And so this also is, when I talked about like, you don't fight the feds, this is the unprecedented global fiscal support. And so this is, various countries around the world, their fiscal response to COVID-19. And so the US is basically around the middle of the page. And so we've thrown in spending and revenue measures equal to about 11.8% of our GDP. And we've topped that off with various loan programs, guarantees, et cetera. And you can see what other countries have done. One of the things that we think is fascinating is how some countries have not spent that much money. And if you look at China on the left, basically the epicenter of the virus, they've actually spent substantially less to get out of this. So that is something that we think for the long haul might be an interesting thing to watch. Will the countries that have spent less, that have come out of it with less debt, will they be in better position moving forward? And you go to the far right of the screen, you can see how much some of these countries have actually spent to try to stimulate their economy. So again, this is one of the reasons why the world is, I'll say, awash in liquidity, and the markets have gone higher.
Yeah, and a lot of the headlines you'll sort of see, right? On the previous slide, we were talking about monetary policy. You hear that term a lot. Here we're talking fiscal policy, right? And people say when those two are kind of working in unison, like it has been this year, right? With the lower interest rates, the spending around the world to help stimulate the economy, those two together really help kind of drive the markets and the future prospects of the economy. And to your earlier point about sort of the little bit of the surprise as a result of the Georgia runoffs, right? Where typically sort of the prevailing wisdom was like, oh, the markets will prefer a split House and Senate. Well, with the Democrats taking control, the markets sort of thought, hey, we're probably going to get additional stimulus. And that probably played into it. Yeah.
And so, despite all this, we wanted to put this reminder out there that there's still a lot of risk out there. And as you can see on this really simple graph that, we're in a problem area. I mean, we're basically matching the early pandemic highs. So, this is still a problem for us. It's a problem for the world. Some countries obviously are dealing with it better than others, but this is something that we always have to keep our eyes on. And we would tell you that, as everybody knows, there's now this new South African, mutation of the virus, that if that ends up becoming an out of control situation, we could probably face some more obstacles in the market.
For sure.
So this is, I'll say we've done a lot of these JP Morgan slides in the past, so we're going to go through a series of them. And so this is the S&P 500, the history of it since 1996, and it's basically called the inflection points. And so on the far left of the screen, you can see the big rise leading up to the tech bubble, big 106%. You can see the sell-off. And then you can actually see in the middle of the page, that's basically leading up to the credit crisis. And the markets really didn't get out of control then. We basically just got back to where we were with the tech bubble. So it was a 10-year period where the markets basically just went sideways, but we sold off very strongly, 57%. And then from March 9th, and if everybody remembers, March 9th, that's the bottom of the market. And a little bit prior to that, Warren Buffett had taken out an op-ed in the, I believe it was the Wall Street Journal, telling people to buy U.S. equities because he was. And the reason he was saying to do it, he just thought they were cheap. A big sell-off like that has Mr. Buffett salivating and just buying, buying, buying. And if you look at that meteoric rise, I mean, a massive swing up until the pandemic sell-off. You see the big sell-off and then the recovery. So we're kind of back on that trend line. But one of the things we want you to focus on is just how expensive is the market right now. And inside the red circles, you'll see something that's called the forward price to earnings ratio. So leading into the tech bubble, that number was 27.2 on the left side of the screen. And the way you get a price to earnings ratio is fairly simple. If a stock is selling for $100 a share, and it earns $5 a share in profit, you divide 5 into 100, that gives you 20. The higher that number, the more expensive a stock or an index in this situation is, the lower the number, the cheaper. So going into the tech bubble, the market was actually considered very expensive at 27.2. In the middle of the page, it really wasn't that expensive. As I mentioned earlier, it was at 15.7.
Because the bubble wasn't really in the stock market. It was in the real estate at
just
that time.
A lot of issues, right? We were dealing with a lot of hidden issues, I'll say.
Yeah.
But if you go down to March 9th, 2009, that forward price to earnings ratio became very cheap at 10.3. And then if you move up now to where we are on December 31st, 2020, 22.3. So we're getting a little expensive. We're nowhere near where we were on March 24th of 2000. And with the next slide, I'll put it a little bit in context. So this is the, I'll call it the 25-year history of the forward price to earnings ratio. So you can see how it was climbing going into the tech bubble. So the market was getting more expensive. And you can see how it basically has sold off over the years, where it's been lowered all the way up to the credit crisis, the bottom. And then we're starting to progress higher again. But on the far right, you can see, as I mentioned earlier, that we're now at about 22 or so on the forward PE. But one of the big differences between now and I'll call it the 2000 timeframe is interest rates. If you look at in the 2000 timeframe, you could generally get about 5 and 6% for CDs and money markets. Right now, that number is 0. And so there's a lot of times you'll see some strategists, and I'll call it grizzled vets of the market. They'll say, you know what, this number is high when you look at it. By just looking at the number itself, it's rivaling the tech bubble. However, when you compare it to alternatives, they'll argue that the market is not that expensive, meaning that if I can get 0% or 0.5% if I'm really lucky on some online savings account versus 5 or 6% back then, that, you know what, the market, if I can get a 2% dividend yield out of the market, that's actually not that bad. So an interesting way to look at it.
Oh, let me get you here.
There you go. So this is the S&P 500 performance of 2020 broken down by sector. And there's basically 11 sectors within the S&P 500. So they've actually broken it down even further than that. And so you can actually see where the action was. And as I mentioned earlier, you know, for some people it was business as usual with a twist. And, you know, they were able to immediately have people working remotely and their businesses didn't miss a beat. You know, I've been on some of these earnings calls for companies where they said it turned out that their salespeople turned out to be a lot more productive during the pandemic because instead of getting on a plane, flying across the country to meet somebody, they were now having Zoom calls. And they could have 5 or 6 Zoom calls in a day versus maybe just 2 or 3 meetings, you know, around the country in a day. So really fascinating when you look at it. The obvious online retail, you know, the Amazons of the world, right? Incredible setup for them. Did tremendous. Technology, info technology, which is Apple, Microsoft, Visa, etc. You know, those companies basically were up 44%. And you can just go down that list. Home improvements. Everybody wasn't spending money in restaurants. If you go to Home Depot and Lowe's, they were spending money there. Grocery business. groceries were great because people weren't spending money in the restaurants. Communication services, which is Facebook, Google, Netflix, all that doing extremely well too. And so just all the way across there. The only one that's somewhat surprising, restaurants right around the middle. For whatever reason, they've rallied back by the end of the year. I would have said I wouldn't have expected that as much because I still think they're in a difficult situation, especially in areas where the climate impacts how many people can go to the restaurant. So I still think there's some damage there. But on the right side, you see the businesses that are really struggling: energy, airlines, retail real estate investment trust, hotels, resorts and cruise lines, residential apartment buildings. We were surprised at that damage there. The office one, not as surprised at, because there's a lot of people think that they will shrink office sizes. And the banks, I mean, the banks actually rallied strong going into the end of the year. They were actually in worse shape. But, the issue with the banks everybody had was, were they the ones that were going to actually eat a lot of this debt? If like people weren't working, would they have houses to foreclose on? Would they have credit cards that go into default? And surprisingly, it has not been anywhere near as bad as people thought it was to begin with.
And Al, wasn't there kind of a direct line between sort of the energy performance and some of the risks of the debt that the banks were holding?
No question.
There, right? Yeah.
No question. And what Jason means by that is probably the initial shock to the banks was, if you think about all the debt in the energy business, when oil dropped from, I forgot what the dollars were at one point, if it was $70 a barrel, and it got down to, at one point, it got inverted, which we won't get into that.
Negative, yeah.
But the issue was, if it costs more to produce a barrel of oil than what you could sell it for, that wasn't good for the banks that had loaned them the money, right? So
right.
There was a lot of fear there that what could happen. And so I think we're now going to come on Jason's favorite slide, so I'm going to let him take this over.
Sure, thanks. Yeah, some of you have probably experienced us sharing this slide with you before, because as Alp said, this is my favorite slide. I think it's just a great kind of reminder as you look at kind of the natural and normal action or movement within the markets in any given year. So just a quick lay of the land on what we're looking at here. So this goes back to 1980. And again, we're just talking about the S&P 500 as an index, the 500 largest companies based here in the US. And it's basically showing us with each of these gray bars, it's what did the S&P 500 finish the year at, right? So in 1980, the S&P finished the year up 26%. In 1981, it finished the year down 10%, and so on, right? So you can see the movements all the way across, right? You look here, 2008, during the financial crisis, finished the year down 38%. Come over through 2020, finished the year up 16%. Okay. So, one of the observations that we always make is, hey, during that period, there's been more up years than down years. Okay, that's good. That's what we like to see. But then here's where I think it gets really interesting is when you overlay the red dots. And what the red dots are showing us is what was the largest intra-year decline. Okay, so even though in 1980 the S&P finished the year up 26%, at one point during the year it had a decline of 17%. Okay, and so as you look across here, you can see that, not only, all right, most years were positive, and in fact, the average returns during those years, or excuse me, despite most years being up, the average intra-year drop, right, the average of these red dots was actually a decline of 14.3%, right? So it's just, to me, it's a good kind of clarifying reminder that movement in the markets, downturns, pullbacks are normal, are natural, right? So you see some of the extreme years, right? We saw 2008 finish down 38, but it was actually at one point down 49%. The next year, right, started out really low, but then had a really strong recovery. 2020, right? What a phenomenal example of just how quickly things can move. Alp talked about how we went from the end of 2019 to that low point. That was the fastest move from a bull market to a bear market, and then to finish the year up 16 with the fastest reversal, right, out of a bear to a bull.
Just a great reminder of why you got to take a long-term perspective on things. And this is another one. This is the S&P 500 over the last 26 years, and they've actually brought up like some of the reasons for the sell-off. So not many will remember this, but I actually remember this. I'm aging myself, but August 31st, 1998, fairly quick drop in the market. It was the Asian financial crisis, and there was a hedge fund that needed to be bailed out, long-term capital management. It was what my memory, that they have LTCM written there.
Yep.
And the funny thing is, I actually believe that bailout was something like to the tune of, I'll call it a couple $1 billion. And so, today, after we've been through the credit crisis and what we've gone through with the pandemic, it seems like such a small number, even in 1998 dollars. But, you can actually just see like the various times the market has sold off and what the reasons were. And what they've overlaid that with is something called the Volatility Index. And there's actually a index that measures just how much fear there is in the market. And you can actually see what happens when the market is selling off. That fear index spikes up. In the middle of the page, a massive spike up, a very rapid spike up. And a lot of times people think that when you go through a fairly docile period and all of a sudden like just starts accelerating, you will get those big spikes because it was so stagnant for so long. And you can see that, we've had ever since the credit crisis, the VIX went up a few times, but never to really big fear levels. And it was never enough to send the markets down into bear market territory, which defines it as which is defined as a 20% decline. So, we got close to that in the fourth quarter of 2018. The markets were selling off fairly strongly, but it actually never breached that 20% level. So we had this incredibly long bull market. And then if you think about what happened in 2020, again, that massive spike in the VIX, that just a lot of fear out there for a fairly short period of time, but just a good reminder. And this is a cool slide. This is, the markets basically since, what do we have here? I forgot how far away, basically 1890s, right?
Yep.
And one of the things we like to point out on this slide is the markets have this tendency to go through these periods of stagnation. You can see from 1890 to 1920, and Jason, don't make a joke that I should remember that. But the market's basically going sideways. And we had the Roaring '20s, and then we had the Great Depression, a big sell-off. We recovered, but then we went sideways from like 1933 to 1940. We had the post-war boom. We had a period of stagflation. We had the Reagan era boom followed up with the tech boom, which was just a major upswing in the market. And then we went sideways for 10 years. I mentioned earlier that the S&P 500 basically went 10 years without moving up. It was the first 10-year period in history where it actually had a 0% return. And then ever since then, we've had a really strong market. So again, it's another example of you get these periods of expansion after periods of stagnation and a lot of doubt along the way. I think when the markets, first took off on this, I'll call it 10-year run, everybody was doubting it, saying, doesn't make sense. We just got through the credit crisis and, we're probably going to roll over, and it just continued to move forward. So again, a great long-term view. It also reminds me to say to the younger investors, you always have to think long-term. If you're, 25, 30 years old, there's going to be a lot of hiccups along the way. But if you actually keep the money invested in the long haul in good companies, good funds, good indexes, you'll come out ahead. Next slide.
Yep.
So this is just a good example of what happened to the economy. You can see on the left side just the real GDP growth, and then this big drop off that we've had. And really the example that we're bringing up here is, while the markets have recovered, the economy has not, right? There's still a lot of weakness in the economy. The growth is very weak. I think we just got the fourth quarter growth numbers, and that turned out to be weaker than people expected it. And it's basically, while we grew 4%, it's off of a really low base. So, we're still nowhere near where we were. And if you look at the components of GDP, 68% of our economy is consumption based. And so that's where we actually need to see people spending money. And a lot of people have actually saved money. They haven't traveled. And so we have a slide coming up that shows the consumers actually, they've reduced their debt load. So it's interesting that for us to get back to where we are, we need to see some of those businesses come back. And we need to see people spending money, whether it's traveling, but just on more things that, they basically on a temporary basis stop spending money on. Next slide. So this is the consumer balance sheet on the left side, and you can see that total assets right now, 140 trillion compared to the third quarter of 2007, which was basically right before the credit crisis. Assets were 85 trillion, and at the low got down to 74. So a lot of growth, and you see the value of their homes. On the bottom, you see their financial assets, pension funds. Again, fairly strong growth. Liabilities are modest right now, and I'll go to the top right on the household debt service ratio. Fourth quarter 07, things after the credit crisis really just got a lot better. And so we've had this long period around 9%. So this is debt payments as a percentage of disposable personal income. So think of all the refinancing either you've done or your friends have done or just family members have done, and how that's allowed people to reduce their debt service. And I said recently, people just haven't been spending that much money. And so I was actually very surprised to see this spike down, because we do know that, as I mentioned earlier, like people are spending money on their homes, but I guess combined with the refinancing, they've still been able to wipe out like other debts. And I realize you could say, well, that doesn't make sense. There's a lot of people that are out of work right now. This is probably dominated by the people that haven't lost their jobs.
For sure.
Where the sector of the population that has lost their jobs has generally been on the lower income side. I know there's some in other businesses, but predominantly it's been, I'll call it the restaurant workers and hotels, et cetera. So hospitality have not been as high paying as other sectors. But bottom, another example, the household net worth just creeping up. So really a positive. A little bit of, I'll say more than a little bit of a negative. This is probably one of the more common questions we get in the office is, can we continue doing this? And this is basically, our budget situation. And so, from a year earlier, we basically had in 2019, and I know we don't have that slide up, but we would talk how the economy grew at about 2.5 to 3% for most of 2019. However, it did it with about a $900 billion to a $1 trillion deficit. So it wasn't a healthy thing. So for this past year, we now have 1.8 trillion dollars of our economy being supported by borrowing. So our total economy about 5.1 trillion. You can see the income taxes we're bringing in on the right side of that, the Social Security taxes, other taxes. But now to meet that $5.1 trillion spending budget, we're borrowing $1.8 trillion. And this is on the bottom right, a really good graphic example of that, of what has happened to the deficit basically since, I'll call it about 2006. It just went up. And if you look at where we are now, we're basically rivaling where we were in the World War II time period on the left side. So the issue is, how do we get out of this? How much of an impact will this have on our economy moving forward? We've been fairly lucky about this, and we'll go over why. But
I'll just add, I think probably the most sort of common response or sort of argument in favor of the deficit spending, at least today, right, is the combination of what we've been talking about, the ultra low interest rates, right? So if there was a quote unquote good time for anybody, but in this case the federal government, to be issuing debt and borrowing money, it's costing them at historic lows, right? So that's kind of the part of that argument. But it's also a simple, hey, we need to reinvest in this economy, right? The economy's taken a beating this past year. And so you combine with low interest rates and the fact that the economy needs it, and by needing it, you can make the budgeting argument to say, hey, to drive up the revenues from income tax and corporate taxes, right? We need to reinvest in the economy to get folks back to work, get the businesses reopened, right? And so that's kind of the most common sort of two-pronged argument in favor of the borrowing now. And then just sort of the other piece is,
Actually, if you go back to the slide, Jason, one more
yeah,
comment on it.
yeah.
Go on.
It's just that, and this isn't necessarily a good argument in my view, but it's a problem for another day, right? That a lot of folks just say, hey, we'll worry about the debt later.
And I'll point out that that $1.8 trillion deficit, that is actually before the last round of stimulus. So we know that number is actually going to be substantially higher. And as you know, they're also developing another stimulus plan. So the deficit will be substantial in 2021. So we could probably have possibly a $3 or $4 trillion deficit. I know I'm just throwing trillions around like it's nothing, but so how does this happen? I'll just say we are incredibly fortunate right now that we are still, and I think for probably many decades to come, we are the world's reserve currency. And by that, we get to run our own printing press, which has allowed us to do this. And, during all periods of panic around the world, people like to buy dollars. And the question is, will that end at some point? We don't know that answer.
Yeah, and the other concern that often gets raised is inflation, right? Well, gosh, if you're printing all that money, spending all that money, shouldn't we be worried about inflation? And one of the things that we talk a lot about is what's really kind of unique about this particular time of deficit spending is that the U.S. is not alone. The pretty much every developed economy around the world, and even a lot of the developing economies, are doing the same thing, right? They're printing money, they're spending money, and so it's kind of sort of just raised the inflation rate, if you will, equally across the world. So you're not going to sort of see it spike in any particular country or region because.
And we showed that on that previous slide that we showed you the various fiscal responses from around the world.
Yep. All right.
So this is the what I'll call the employment situation. And on that top left, you can actually see from February 2010 to February 2020, we added an unprecedented 22.8 million jobs, but we lost 22.2 million from February to April, and we've regained about 12.3 million of those jobs. And so I'm sure everybody can do the math. It's still a problem, right? There's still 8 million jobs out there that we need to fill. And on the right side, we're showing you the businesses, like the amount of jobs that they lost and what percent they've recovered. So basically, 8+ million jobs lost in the leisure and hospitality space. So you can just see in the trade transportation space, you've lost about 3.5 million jobs. Again, they've recovered on both of those, but only 59% and 71%. And if anyone wants to ask the question of why is there that negative on the government, we actually couldn't find that answer out. So
yeah,
ignore that.
Yeah, my best understanding of it was that during this time period, February to April, government had negative job losses, and then since April has actually gotten even worse. So the government is the one sector that hasn't recovered any jobs since April 20. That was my understanding.
But I tried to look that up prior to seeing that. So this is something that obviously was a big part of the last election, not just the nationwide election, but every state, income inequality in the US. And what we have here is the top 10%, their share of pre-tax national income over the last, 65, 70 years, essentially, it has gone up from about 35% to over 50%. And if you think about that, on the next slide, there's a reason why that's not that good of a thing. And if you can increase the wages for the bottom 90%, this shows you that they will spend the money, right?
And as you already pointed out, almost 70% of our economy is driven by consumer spending. Sorry.
And again, not trying to make political statements, but I've actually been in the camp that I like the fact that minimum wage has gone up. I think it was long overdue. And I know some people think, it doesn't make sense. But the reality is it just didn't keep pace with inflation. And so that's the part that when I look at it, and I try to look at it objectively and just say, yeah, it needs to go up. And I've had a number of clients over the years that when we've talked about this topic that have come to the conclusion themselves and said, you know what, I like that because if their wages go up, and this is without them even seeing this slide, if their wages go up, they're actually going to spend more money on the economy, which is good for all of us. It's good for stocks. So
Yep.
it's an interesting example, but it's something that I think this has to be addressed in our country. So I don't know what the answer is other than you're seeing a lot of companies increase wages. I saw the Bank of America CEO Brian Moynihan interviewed last night. I believe it was on Bloomberg. And he was pointing out that, in their company, they really have raised, I believe, the minimum wage possibly to $20 an hour across their entire company. And they said that it's been incredibly well received by just their banking customers around the world.
Mm-hmm.
This is a good slide on where the action has been. And so this is the year 2020. What actually led the way were the growth stocks. And by that, I'll say the so-called FANG stocks, Facebook, Apple, Amazon, Netflix, Google, Microsoft, et cetera, which is not in the acronym of FANG, but Microsoft in there also. But the growth stocks really have led the way, and they've led the way probably for 3 or 4 years. But nipping at their heels was emerging markets Asia, a big turnaround. We've seen those stocks do really well. Japan had a strong recovery. Value stocks, which have been weak for, I'll say, almost the last 5 or 6 years, they've been outperformed by the growth stocks by a wide margin. They came back alive over the last 3 or 4 months. As I said earlier, the rally really did broaden. Europe came up a little bit, still weak, and emerging markets, Latin America, kind of bringing up the bottom, but also picked up strongly at the end. So it's really interesting to see where the performance has been. So this is actually one of my favorite slides. So I get to counter Jason's favorite slide. So this is the slide that one of the first JP Morgan slides that we started with. It's the S&P 500 at inflection points. That's the gray line. It's been overlaid with the MSCI All Country World ex-USA index. So I'll call it the rest of the world's stock market. And so from 1997 to basically the end of 2020, you can see the performance. And if you look at it, they kind of went in tandem, where there's periods where, the US outperformed and then the international played catch up. And, like in the middle of the page, they were basically trading at par with each other. Coming out of the credit crisis, first couple years, they traded in tandem. And then around 2011, 2012 time period, it's been a complete US story where the US markets have recovered very strongly, but the rest of the world was basically moving sideways. And if you go from that peak in the center of the page to the far right, even after this rally in the last, I'll say, 3-4 months of 2020, the international markets have a lot of catch up. And so if you look at that forward price to earnings ratio inside of it, 16.7. So those markets are substantially cheaper than the US markets. And, in addition to that, they haven't had the same growth. And so if they get faster growth, you'll actually see that PE stay lower for a while until the stock prices really come up. But many people have predicted that this gap will close at some point. They said historically it has always closed, but this is probably the largest gap in modern history right now of US just outperforming. And a lot of it, I think, we thought there was a decent amount of recovery around the 2017 time period. You can see about an inch from the right there. Jason's got the arrow pointing to it right now. But that got derailed with all of the trade talks. So in 2018, what we like to call the Trump tariff tweets, when that hit, that actually sent the international markets kind of spiraling downward. And as we mentioned, we thought that they would actually favor the probably easier trade policies to digest under a Biden presidency. And that's why you've started seeing this rally back. And it's actually been a fairly strong rally for them, and anticipation is it will continue.
And part of the longer term kind of case to be made for the international markets, in particular kind of the emerging markets that what Alp's going to highlight here in a moment, is around demographics. And Alp, I think you're going to talk about that, yes?
Absolutely.
Yeah.
So this next slide, it actually talks about the differences in growth between emerging markets and developed markets. So the purple line is the growth that you see in emerging markets. And so generally the growth in emerging markets is substantially higher, at times gets up to 6%. And the US, we've struggled. We've generally been, at times breaking above 3%, but really for the last 10 or 11 years, I think the average has been closer to around 2.25%. And if you look at the growth on the emerging markets, still substantially higher. So that's one reason why people should really consider emerging markets in their portfolio. But what we think is a really fascinating example of why emerging markets probably have a pretty strong runway ahead of them is if you look at the growth of the middle class in those populations. And so this is 1995 in the gray, 2019 in the purple, and in the light blue, a 2030 forecast. And so if you just look at the percent of the population, like the growth into the middle class, 17%, but then forecasted moving forward, 79% growth. Indonesia, the same story, incredible numbers. China, incredible numbers. Mexico, incredible numbers. And they actually had a lot of growth just over the last decade. And so you can see they had probably the best purple line of the bunch. But so if you look at the emerging markets and you compare it to the growth in the developed markets, it is a strong case for why you should include emerging markets as a part of a globally diversified portfolio. So I know we go ahead, Jason.
Yeah, I was going to just mention, I know one of the questions we had was related to the dollar here. It says, what changes in the value of the dollar are we likely to see under Biden? So Alp, I don't know if you want to address that now or maybe later.
So I'll take it now. I'll just say that when it comes to whether it's the Biden administration or any administration, what really happens is there's usually these secular shifts in the dollar. And the dollar has had a strong rally for a long period of time. And so people have believed, just as you've seen that U.S. markets outperform the international markets, people generally believe that you'll see secular changes. And so the thought is that with all of the printing we are doing and the fact that the dollar has been strong for so long, we will see it weaken. And we've already seen that. I know Stephen Roach, he used to be chairman of Morgan Stanley Asia. He was out over the summertime predicting a 25 to 30% decline in the dollar. I think you could Google search. He might have actually said even a larger number than that. And we've seen a decent decline as it is. And my guess is if we actually break through where you see like maybe a half inch from the, I'm looking at the chart on the left, we're coming up on kind of an interesting, what I'll call technical level. If we break through that level, you could actually see the dollar decline kind of rivaling back down to the 2012, 2013 time period. That is great for the US economy when it comes to exports. It's not that great for if you're importing foreign goods. If you're traveling overseas, your travel will cost more. So, there are some pros and cons, but for US exporters, it will be a good thing. And you can see the trade balance on the top right, but there you go.
Yeah, get kind of that inverse relationship, right? As this comes down, this goes up, as Alp was just describing.
All right. This is actually asset class returns from 2006 to 2020. Like typically we're in front of a live audience, we always joke if they can actually guess what the trend is. And so we have people, look at it, and people, look at it for a minute or so, and they throw up their hands and throw some guesses. And the answer is there's really no trend line, right? It's just fascinating that when you look at the different asset classes that you can get these periods of strength followed by periods of weakness. And if you look on the far left, emerging markets, 3 out of 4 years led the way. They got hammered. And my example, they are much more volatile. Got hammered in 2008 going into the credit crisis, recovered fairly strongly. Then you see this period where real estate did well. And if you think about what drove real estate, and real estate stayed on the top half from that period forward for, just I think the entire time. But what actually, except for 2020 on the bottom because of what we already talked about, but on real estate, driven heavily by interest rates. So whether you had your own home and you watched its value go up, or if you invested in apartments or office buildings and retail, all of that was appreciating as interest rates were coming down. Then you also saw what I'll call that second wave of the tech expansion, large cap, that the green box just do really, really well up near the top for a long period of time. And if we always point out, like in the middle with that asset allocation, with the diversified portfolios, one of the things you'll notice is your performance kind of stays in the middle. So you kind of avoid the big upswings, but you also avoid the big downfalls. So, looking forward, the big question is, what is the change we're going to see in 2021, 2022, 2023? Our thoughts are we will see some of the international markets perform better. Large cap growth could still surprise us, but it's had such a strong run. We wouldn't be surprised to see that settle a little bit. And small caps actually did well in 2020, and part of that is they had underperformed for a number of years and basically have come back up a little bit. So,
all right. Hey, I'm gonna just double check a few of our questions that came in. One of them, Alp, was particularly interested in 2021 post-election sector/stock recommendations.
So I would tell you that the U.S. market's difficult to make predictions on because we're at this elevated level that we've shown you. And I realize I mentioned that maybe we're not that elevated when you factor in interest rates. But nonetheless, I'll say the U.S. markets aren't cheap. They've recovered much stronger than other markets. And this might almost sound like a broken record story, but one of these days we will see that reverse out. We don't know when it is, but we think, the odds continue to start favoring things like emerging markets and other international markets, that if they will pick up some momentum. And on the emerging market side, I personally favor, I'll say, what I'll call EM Asia, so emerging markets, Pacific Rim. We think those really are the fastest growing economies around the world. When it comes to specific sectors, I'll say right now it's still kind of up in the air. It's really dependent upon, and I'm not trying to dodge the question, which I am, but it really is dependent upon how we come through this virus to really get a better understanding of what probably could happen in the markets.
I mean, I know there's been some talk, right, from a regulatory kind of bullseye perspective that some of those tech names may be under more scrutiny going forward, but it's really hard to bet against them. It's just given how influential, how powerful, how profitable a lot of those big names are. But
absolutely.
Yeah.
So we've had a lot of questions over the past year about, well, what happens if the administration changes and Biden wins the election? And one of the things that most people don't realize that over history, and again, this comes as a shock to a lot of people, the markets surprisingly have actually performed better with a Democrat in the White House. It's fascinating. A lot of people think that the Republicans are always the pro-business part, but for whatever reason, and I don't know how much this was heavily influenced by the Clinton years, 1992 to 2000, where we had that tech boom. Right. So, that was just a very strong period in our economy. But, we tend to think that the president gets too much credit for a good economy and too much blame for a bad economy. And a lot of it really is just cyclical. So we don't think it matters. We also think one thing that is really favorable, we think we're in this divided period in our history right now. But one of the positives, because of President Biden's age, and again, not making any political statements, we believe he's a one-term president. So we think the markets have looked at that all along favorably, meaning that in 2024, the market is hoping that they'll get two candidates that they think will be a better representation of what this country needs. And on the Biden side, one of the things we've thought all along is that President Biden comes from the tax-friendly state of Delaware. And some of you know that Delaware, there's no sales tax there, and a lot of businesses have incorporated there over the years. So we've always felt that he's not going to rock the boat too much, that he's a fairly centrist politician. And with no major advantage with the, I'll call the House and the Senate, it's fairly close. And with the midterms coming up, I just don't believe they're going to try too many drastic moves.
Yeah, I was going to build on that too. Yeah, even though, right, the Democrats technically control all three, right, the Senate, the House, and the presidency, as we know, their majority in the Senate is as slim as it possibly could be, right? It's 50-50 plus the vice president's deciding vote. And then on the House side, I believe it's just a 9 seat difference on the House side, right? So even though they have control, it is in, you know, a very slim margin. So it'll require, you know, cooperation and compromise, not only within their own caucus, but the Republicans as well.
And it's interesting. I mean, after this divided period, and again, I just look at it objectively and not trying to make a political statement at all. You know, we thought that he could be the person for the job to try to calm things a little bit in this country. So it'll be interesting to see what happens over the next 4 years. On the next one, we'll talk about some of his tax proposals. If he can stick to the top line that he only increases taxes for individual taxpayers with incomes above 400, we don't think that's going to damage the economy much. You know, our preference is they don't raise taxes at all until we're further through this pandemic. And I don't know if many of you know my prior background, but I'm an ex-CPA. I did a lot of tax work in my earlier days in a prior career. And so I personally am not a big fan of higher taxes. It's just ingrained in me. And Jason's laughing because he hears me talk about it occasionally.
Say it lightly.
But we think a big mistake would be to increase the corporate tax rate. And I don't like the rhetoric we hear here. And the reason is we think the markets responded very positively to the lower corporate tax rates in the prior administration. And if you think about lower corporate tax rates, what that does is makes companies more profitable. So it lowers their price to earnings ratio. And so when you look at 2018, when the Tax Cut and Jobs Act went into play, individual companies became a lot more profitable, and you saw price to earnings ratios immediately drop, which all of a sudden started a rally in the stock. So again, we would not be a fan of corporate tax increases, even if they compromise and go somewhere in the middle. I would tell you, I would prefer they stay exactly where they are. It's competitive on a global basis. The last issue they've been talking about is estate tax reform. We've had a lot of questions on this with our clients recently. We think this could easily happen, but even if it doesn't happen, the provisions in place right now are set to sunset in 2025. Jason, is that correct?
Yep.
So we think there's going to be some reform here. You know, it's just a question of how much they lower the thresholds. I believe currently individuals can pass, Jason, quote, is it 11.5 or so, or?
Yeah, about 11.58 million for each person. So, and it's combined now under the new law that married couples can collectively pass that almost $23 million.
Without any federal estate taxes. State
Correct.
Estate taxes are separate. So could we see that drop a little bit? And the answer is yes. I know there's a lot of estate attorneys that we talk to on a regular basis that actually believe that it will go down. And part of it is that the jump was such a large jump when they went to that $23 million number. So again, we could see some reform here.
And I was just going to mention there, I know we're coming up on time here. You know, the headlines is always about the federal estate tax reform, but something to keep in mind for the states that do have a state estate tax, like Maryland and DC, for example, in this area. I think you're going to see some more meaningful reforms at those levels, just as a reaction to how hard their budgets have been hit in recent times, that they're going to look at that as an area to say, oh, you know what, maybe we shouldn't be coupling with the federal levels and having such a high exemption. So I think, you know, we'll be certainly keeping an eye out on those. DC actually just already did such a thing. They lowered their exemption from $5 million to $4 million effective January 1st of this year.
And so this is probably another one of the big questions we get
Hmm.
throughout the year, and probably throughout the last few years as the markets have been in strong rally modes. So are we in a bubble? And if one thing to bring up, if you look at the stimulus that's being thrown at the markets, not just in the US, as we said, on a global basis, we don't think there's a central bank around the world that's trying to do anything to slow down economies. So that's one of the positives. So even if we have corrections, we think the markets will still rebound back, where Goldman Sachs, I think, was out either last night or this morning saying that, if we get a dip, buy the dip. They just feel that this rally is not over yet, and partially is, we still haven't seen a full recovery in the economy. But I'll bring up probably just one of my favorite lines. It's an old line. It says, bull markets are born on pessimism, grown on skepticism, mature on optimism, and die on euphoria. And the time of maximum pessimism is the best time to buy, and the time of maximum optimism is the best time to sell. And so if you look at where we are right now, I would tell you we're kind of starting this euphoric stage. If you think of where we went from the pandemic through now, and you see some of this crazy trading we're seeing, yeah, I would tell you that we're kind of like getting bubbly in the markets. But what's been unique, some things that we've noticed recently, the market's been able to deflate some of these really short-term crazy moves in the market without taking down the entire market. And one thing we always talk about when it comes to the euphoric stage is it can go on longer than you realize. And you never really know when it's going to end. It'll probably end fairly abruptly at some point. But if you think about real estate bubbles in the past, gold bubbles in the past, prior stock market moves, right? It just can go on for a few years before things really get completely out of control. But I would also say the biggest issue that, the biggest obstacle is what I've mentioned earlier, is we really need to get ahead of this virus, right? If that's probably the one thing that could be a further reason for selling if it turns out the so-called South African, mutation is just very difficult
Yeah.
to, battle with a vaccine.
Hey, on the previous slide, we had a question come in about asking, what about change in step up? I know that's been one of the kind of headlines, and I'll take this opportunity to just really sort of highlight one of the items that was on the previous slide, that just this word, the importance of proposals, right? In that there were a lot of proposals, all right, and it takes a lot to go from a bullet point on the Biden campaign website to actual law, right? And I think we talk about this a lot, that it's important to not kind of get caught up in the various proposals and different headlines that are talking about what could happen, right? Because there's always way more of that than what actually comes into play. So having said that, about the step up, that one's an interesting one. I mean, I don't know if I would. I'm not really a betting person, so I wouldn't put a bet either way on it happening. But I know it is something that is in a big mix of items to be talked about. And what that means is under current law, when someone passes away and you inherit an asset, you get what's called a step up in basis for the value of that asset as of the date of death, right? And so in essence, if I inherit, Apple stock, for example, I get a new basis. I get it as of the date of the death. So then if I were to sell it subsequently, my gain would be nothing, right? If I just sold it right at that same day, right? So that would be an influential change, no doubt, if it did happen, and we'll certainly keep our eyes on that to see if it seems to have more teeth or legs to it.
And I'll bring up just something to clarify, that step up in basis is for anything that's owned, I'll call it individually. Things that are owned inside retirement accounts, if you have annuities and there's a lower basis in annuities, all that does not get a step up. So if somebody inherits a 401k worth $1 million, you will pay tax on that when you inherit it. So that money is untaxed income. The government likes to tax it. It's basically things that are owned individually, like stocks, homes, etc. Businesses.
So Al, before I wrap up here, there were just two other questions. When you hear on the radio that orders for durable goods or whatever else were less than anticipated after a 300-point drop in the market, what causes that? Are there investment programs tied to such movement of the numbers to trigger automatic selling?
Yeah, I think it's been a while, maybe 5 or 6 years. There was this flash crash in the market where I think the market dropped 1,000 points in, maybe it was like 15 seconds or whatever it was. So, they got coined the flash crash, and they had a trader on CNBC, and I got my fist up in the air, and the trader did that. He slammed his fist on the table, and he basically said, in the time it took me to slam my fist, our group got off 15,000 trades. So there's your answer, right? There's unbelievable amount of automated trading programs right now, more than there ever has been. I think it doesn't get talked about enough, and I don't think it's going to change unless there is some form of regulation on it, where on a day-to-day basis, um, you know, stocks are just being thrown about like, if they're up a penny, they'll sell. And I believe I heard this morning that like the average holding period is possibly now down to less than a second. I think that's being driven by these automated trading programs. Years ago, it would have been, people held stocks for 18 months on average, and then it got down to, you know, 3 months, and then it got down to weeks. And so, it's incredible now how fast people are trading.
So do you want to take that opportunity to talk a little bit about GameStop and Reddit? I know we had a couple questions come in.
So, my belief is that got started by some of these organizations that, everyone kind of like the younger population is listening to, I'll call it certain feeds. In the old days, it was like the Yahoo message boards, and now there's these new groups that, and one of them is Robinhood. Yep, and also Robinhood, the trading platforms, that they share what others are buying and they show what's trending. And so people tend to jump on those trends. And so, in recent days, GameStop, a business that pretty much almost had the nail on the coffin on it, just fired up by something called a short squeeze, which means that a lot of people were betting that the company was probably going to go to zero. And so they sell shares they don't own. And what happens in that scenario is if the price spikes up on the people that are selling it short, they have to kind of rush in to cover their shorts. And what I mean by that is, let's say they sold GameStop at $5 a share, thinking that it's going to go down to $2 a share. And they're going to buy it back at $2 a share, and that means they get $3 of profit. So that's called shorting a stock. So you're essentially doing the exact opposite of what 99% of the population does, which is hope the stock goes up in price. Mm-hmm. And so what happened is some of these stocks were very heavily shorted, and that data is open to the public. It gets published generally every couple of weeks. And so there was this big attack on the shorts, companies that were heavily shorted. And so there's been a lot of hedge funds that were short companies like GameStop and others that have gotten crushed to the tune of, I believe at this point, they've probably down well over $100 billion just in a couple of weeks, just on GameStop alone, even though I'm talking without knowing what it's done today. But it's incredible. So those platforms are real. We've seen it before. It kind of reminds us of the tech bubble. It's just in a more automated fashion today because everybody can trade faster than they could back in '98 or '99.
Yeah, and recognizing, right, like while that's a lot of money, $100 billion, moving, it is a very small sliver of what we've been talking about. It gets a lot of headlines because it's interesting, it's new, but it is what a lot of times we would call noise, right? And I think it's a great transition to sort of just this slide. While Alp and I love these workshops. We love all the charts. We love all the data. We love looking at the performance, the history, the what's projected. But probably the most important piece is we know that none of us are investing in a vacuum, right? We're all investing within our portfolios for some sort of goal or purpose or need, right? To drive income in retirement or make a big purchase, so forth. And so here's what I want to emphasize: if you're an existing client of ours, right, how important it is to always why we stay in contact to make sure that, hey, is the portfolio allocated, invested in the most appropriate manner for your risk tolerance, your need for risk, your capacity for risk, and for any investor, that really should be the foundation of any portfolio, is making sure that it is appropriate for you and your particular risk profile. So I know we've gone over time a little bit here. touched on both of those. So I just want to make sure, there was one other question that had come in. I want to respect those folks. So what support is available to small businesses for hiring contract, quote unquote, gig workers? And what are the rules for using interns remotely?
So I think you have to look at the latest PPP proposal, Paycheck Protection Program, and see what they're saying for the contract workers. I know it's favorable again for employees, so I don't know that answer actually. If you send me a note, I will try to do a little bit of homework on that and get back to you on it. But there are ways you can spend whatever you get out of the Paycheck Protection Program on other things for your business and still and essentially get the money totally tax-free. And so when we talk about using interns remotely, Jason and I talked about this a little bit before the call. I would tell you uh, really no issues there on where you're using it. There's something that's an unsolved question because there's no legislation out on it, and it's a question of everybody working remotely in their homes. Like, what happens to liability? What happens to, where should employment reports be filed that says that I now have employees in 5 states that I didn't have before because my people are working remotely? And I'm going to say no answer, right? It's a great question, and it came up to us probably a couple months ago, and we'll find out if they clear this up.
Yep. Not uncommon, right, for legislation to have to catch up with with reality, with what's going on. So thanks for joining us, everybody. Really appreciate your time. Please follow us. You can check out our recordings of this workshop and all of our workshops. We do these monthly, so you can check us out on our website. Here's our team. Great looking bunch. Here's our contact info, so feel free to reach out to us with any questions or if you'd like to schedule time to connect. And so without further ado, thanks a lot, everyone. Take care. Be safe.
Yeah, definitely be safe, and a late Happy New Year to everybody.
All right. Goodbye.
Take care.